You're selling your nurse practitioner practice for $850,000. Sounds great, right? Here's the problem. Depending on how you structure that deal, you could owe the IRS anywhere from $100,000 to $250,000. That's a $150,000 swing based entirely on decisions made during negotiations. Let me show you exactly how this works. When you sell a practice, you're not just selling one thing. The purchase price gets split across different asset categories: goodwill, equipment, supplies, non-compete agreements, and patient records. Here's the key. Each category gets taxed at different rates, and those rates range from 0% to 37%. Goodwill is your best friend. That's your reputation, your patient relationships, the value you've built over years. Goodwill gets taxed at long-term capital gains rates, 15 or 20% for most NPs. Compare that to non-compete agreements, which are taxed as ordinary income at up to 37%. Same dollar, very different tax treatment. Here's a real example. Sarah sells her practice for $850,000. The buyer wants to allocate $150,000 to the non-compete agreement. At a 35% tax rate, that's $52,500 in federal tax, just on that one line item. If Sarah negotiates that down to $50,000 and shifts the other $100,000 to goodwill, she saves about $15,000 in taxes. Same sale price, different allocation, real money in her pocket. Watch out for depreciation recapture. All that equipment you deducted over the years, exam tables, computers, that ultrasound machine. The IRS wants some of that back. When you sell depreciated equipment for more than its book value, the gain gets taxed at up to 25%. If you took bonus depreciation recently, this can add up fast. Don't forget state taxes. Texas and Florida, no state income tax on your sale. California or New York, you could owe another 10% or more on top of federal taxes. Where you live matters a lot. 3 strategies to minimize your bill. First, negotiate the asset allocation. Push for more goodwill, less non-compete. Second, consider an installment sale to spread gains across multiple years and potentially stay in lower brackets. Third, maximize retirement contributions in the year of sale to offset ordinary income. The biggest mistake I see: NPs waiting until after closing to think about taxes. By then, the allocation is locked in. You need a tax professional involved during negotiations, not after. The decisions made at the negotiating table directly determine your tax bill. Selling your practice is probably the biggest financial transaction of your career. The difference between a well-structured sale and a poorly structured one can easily be $50,000 or more. If you're thinking about selling, talk to a tax professional before you start negotiations. Visit nursepractax.com consult to schedule a free strategy call with our team of enrolled agents and tax attorneys. We'll help you structure the sale to keep more of what you've built. Visit nursepractax.com consult to schedule a free strategy call with our team of enrolled agents and tax attorneys.